Hi all, we are going to discuss RAROC, that is risk adjusted return on capital. Here the first question is, which among the following is key factor in investment decision, that is RAROC. So it is very important factor for investment decision. And next one is, the higher the risk, the higher would be the capital requirement. So whenever there is a high risk involving in a business, for that business higher capital is required. And next one, an investment will be more preferred and higher will be the reward to investors when RAROC is higher. When this is higher, then profit we can expect more. Now we will see RAROC concept. So profit planning involves balance sheet management, and higher risk will fetch more profits, whereas lower risk is the cause of lesser profits. So what is the relation between this risk and capital? We'll see first. So risk is possible unfavorable impact on net cash flow in future due to uncertainty of happening or non-happening of events. So risk means it is an unfavorable impact. So now what do you mean by capital? Capital is a cushion or a shock absorber required to absorb potential losses in future. So why we need capital? So whenever there is a what we can call loss in future, so by more capital we can recover from the losses. So here in the third point he is telling, higher the risks, high will be the requirement of capital, and there will be a rise in risk adjusted return on capital. So this is how there is a relation between risk and capital. So whenever there is a more risk, there must be a more capital, that is both are proportion. And coming to next concept, bank's income compromises of the three components. Those are, so basically we all know that, so bank's income is depend upon which components? So basically banks depend upon interest on loans basically. Then the fee we are charging on income, like fee based income means fee we are charging on loans. And next one, treasury income. This all we know that in earlier treasury only the main factor for these banks, and this is also one type of income. Treasury means we all know that banks they will manage the money by investing in gold, in share market they will manage the money. That's how we will get the profit from treasury. That is called as treasury income. So here he is telling bank's income compromises of three components. First one is interest from loans, fee based income, and treasury income. Next, then what is the bank's expenditure? So we all know that how bank will spend its money, or what is the bank's expenditure means. The first one we all know that staff expenses. Next one, interest on DD, that is demand deposits and time deposits. And next one, other operating expenses. So here we discussed what are the bank's income components and what are the bank's expenditure components. So income means it is interest from loans. So expenditure means interest what we paying to FD and TDs, that is time deposits. And next one here is telling income means fee based income, and here in the expenditure it is staff expenses. And he is telling treasury income is the component for income, bank income, and other operating expenses are the expenditure for bank's expenditure. This is the these are the components for bank's income and expenditure. And next one is motive of the bank. So motive of the bank is to expand income and reduce expenditure. Obviously whenever not only bank, if it is a company also, what they look for, they want to expand income and they want to reduce expenditure so that profit can be maximized. But in order to expand income, what we have to do? In order to expand income, more risks have been incurred which requires higher capital. So to get the more profit, more risk we should take. To take more risk, we need more capital. Now So now coming to bank's policy. So bank's policy must be to invest in such a manner that optimum yield can be obtained at a given level of capital. So then we should be a policy for a company or a bank to manage this money. So here he is telling bank policy must be in a manner that optimum yield can be obtained at a given level of capital, and bank's non-interest income can be increased by cross-selling, that is third-party products, and widening scope of treasury. And one more thing, bank's profit can be enhanced through effective management, and low-cost deposits must be increased to enhance profits. And now, risk aggression and capital allocation. Through RAROC approach, each risk is measured to determine both expected and unexpected loss using VAR, that is value at risk. Very important for case study. This is value at risk. Repeating, through RAROC approach, each risk is measured to determine both expected and unexpected losses using VAR, that is value at risk. So expected losses are covered by reserves and provisions. And next point is unexpected losses require capital allocation determined on the principle of confidence interval. Remember this, on the principle of confidence interval, time horizon, and diversification and correlation. So we use this confidence interval and correlation, diversification, and this time horizon in calculating unexpected losses. How we will calculate these unexpected losses, we will see in the next slides. So there is a formulas for this risk capital and risk adjusted performance measures. So here to calculate the risk capital, so usually what is this risk? What is the risk capital? So basically usually the loans which we are giving without collateral, means how we have to tell. So for some portion of amount only we will take the collateral. So that is called as non-risk. So for the amount which is not covered under the collateral is called as risk usually. So here the risk capital means business volume into volatility into probability. So here business volume means you will give that capital required for that business, that is business value. And this volatility, so volatility is nothing but standard deviation. Remember in the previous examination July 2022 he asked, so he asked to calculate standard deviation, then he asked what is the volatility. So volatility is nothing but standard deviation. Remember, standard deviation, not variance, it is standard deviation. Next one, probability. With probability we have to multiply to get the risk capital. So risk capital means this is the formula. Next one, risk adjusted performance measure, that is RAMP, RAMP. So risk adjusted performance measure means it is profit by risk capital. So we have to divide profit with RC, that is risk capital. So we'll see one example based on these formulas. So there are two traders. One is forex trader and the other is bond trader. Each is having profit of 10 million USD last year. The performance each can be compared as under. Given data is deals in amount, volatility, probability table at 19%, and the last column, fifth column is risk capital. That is the question he asked. So those answers we have to write. So here for forex trader, that risk capital is, so what is the formula for risk capital in the last slide we saw? That is multiplication of business volume, volatility and probability. These 2, 3, 4 columns we have to multiply. That is 100 millions, 12% and 2.33 we have to multiply. So after multiplying this we will get 28 million USD. And next one is risk adjusted performance measure. So this is nothing but profit by risk capital. So profit here is given in the question is 10 million USD. So 10 by 28 will give 0.3. And for this bond trader risk capital, we have to multiply the second column values, the given for bond trader, that is 200 million USD into 4% into 2.33. That will give 18.6 million USD. And similarly, risk adjusted performance measure, that is RAPM, that is profit is common for both, that is 10. So 10 by 18.6 will give 0.53. So in these two things, so the best one is the higher RAPM. So higher RAPM is for bond trader, that is 0.53. So this one is the preferable one. Thank you for watching. Please subscribe for more videos.